What if the rule book of global economics, the one we've relied on for decades, no longer applies? This intriguing question forms the foundation of our exploration today as we delve into the insights shared by Kevin Muir on the state of the global economy and financial markets. In the wake of COVID-19, the economic impact has been nothing short of unprecedented. Traditional models and playbooks, once the cornerstone of economic predictions, seem to be less reliable. Yet there's a silver lining: the significant amount of fiscal stimulus like infrastructure spending still making its way through the system. This underestimated factor is poised to continue supporting economic growth. A noteworthy shift has occurred in the management of the economy. We're seeing a stronger reliance on fiscal policy rather than solely on monetary policy. This could potentially usher in an era of higher baseline inflation, perhaps around 3 to 4% compared to the traditional 2% target. Geopolitical factors are also playing a substantial role in shaping the economic landscape. An example is China's intent to diversify some of its vast foreign reserves into gold. This move is offering significant support for higher gold prices, irrespective of factors like interest rates and the dollar. Let's turn our attention to the Federal Reserve. They've pivoted to a less aggressive stance on interest rate hikes, considering the lagged impact of tightening financial conditions. This shift decreases the risk of a recession in the near term. Rumor has it that Fed Chairman Powell might tolerate slightly higher inflation to curb recession risk. This is partly influenced by the political establishment's desire to diminish the chances of a Trump presidential win in 2024. A debate is brewing around whether the Fed's latest pivot towards lower rates truly signifies an easing of monetary policy or merely an adjustment to lower inflation expectations. The Fed appears to be putting more emphasis on forward inflation rather than backward-looking inflation. For investors, the recent reversal in the negative stock-bond correlation has been a significant challenge, particularly for institutional investors relying on bonds as a portfolio balancer. This trend may persist, potentially affecting long-term bond returns. Retail investors, however, hold an advantage over institutions. They can sidestep the career risk that pushes large investors to chase performance from stocks like the mega-cap tech names. Retail investors can afford to wait for mean reversion, suggesting a look at equal-weight indices and steering clear of the overcrowded mega-cap tech space. Geopolitical factors might compel continued fiscal spending and higher inflation for years to come. While bonds may experience a short-term lift, higher inflation could harm them in the medium term. The takeaway? Focus on what markets will do, not what you think they should do. Anticipate fiscal dominance, higher inflation, and the challenges this presents for investing. Position your portfolios accordingly. In essence, we're looking at an evolving global economy, influenced by unprecedented factors and moving towards a future that might not align with traditional economic models. It's an exciting, albeit challenging, time for investors and economists alike. To navigate these uncertain waters, keep an eye on the tides of change and adapt. After all, in the world of economics and finance, change is the only constant.